Hello ladies and gentlemen, my name is Pavel Sverdlin. Thank you for tuning in to Ascending Abundance YouTube channel where I cover various strategies on how to make more money with the money you already got, increase your capital rather than decrease your expenses. I am a CFA and a CPA, so Chartered Financial Analyst and Certified Public Accountant. However, I'm not a planner, I'm not an advisor. All that follows is not financial advice, it's just my own personal take on various companies, strategies, businesses, crypto, stocks, etc. that I do for my own personal use, as well as to educate whoever wants to get educated on this channel. It is not a financial advice. So moving with it, I've taken a liberty of exploring the S&P 500, the top 500 companies, with the methodology that I myself developed. It was not back tested. I don't know if my methodology will beat S&P 500 returns in any way, but it definitely gives me comfort in doing the fundamental analysis of the companies that I invest in. So the first one was about Apple. This one is number 2 on the list. It's Microsoft. So if we look at S&P 500 holdings, Microsoft takes the second position. All I do is Microsoft Investor Relations. Click on SEC filings, Securities Exchange Commission. That will give us all of their filings. So you want to look at annual, and annual filings will bring up something called 10K. So 10K, the last one, annual return, was in July, so it's almost a year ago. It's kind of dated, so what I'm going to do, I'm going to review annual returns, and then I'm going to take a look at the Q3 of 2023, so it gives me 3/4 of the past year. Kind of enough to get the gist about the company. And all you do is you click on this PDF icon and the financial statements come up. This is on the other screen that I'm using. Here we go. So investor relations, annual filings, you go to the beginning of it. This is what you will see on the screen when it does pop up. Click here, second page, table of contact, or they call it index. Excellent. Financial statements and supplementary data, and it comes up to the income statement, which will be followed by balance sheet, which will be then followed up here. You can see the cash flow statement, equity, and so on. I do a very simple, straightforward, pretty much calculation that I believe is simple and I believe is straightforward, but I'm hoping you will agree with me. It doesn't take too much time to do this. It is quite insightful and yet does not take forever. So first thing I do is I look at the income statement. I've pre-populated the Excel spreadsheet. All I do is I really look at total revenue, which I call sales, and then I look at net income. Here's net income right there. I don't really care about all of these in-between items, the composition of the cost of goods sold, the profit margins, all of that is great, but ultimately the company needs to make money. If it's not making money, then there's something wrong, and I will note it. It doesn't mean I'm not going to invest in it, but that is not something that I'd be really diving into typically. The company needs to make money. This is their revenue, this is their profit in the last 3 years. I'm also picking up the third quarter of 2023 in the same table. So you could see their profit margins, net profit margin after tax is actually increasing 36, 37, 38%. This is phenomenal, to say the least. Phenomenal. After all of the expenses, taxes, research and development, depreciation, this is great. But doesn't make for a great company. It's just their business is very profitable. Let's look at their balance sheets. So next page, balance sheet. My approach, as I've described in the previous videos, I look at total assets and then I want to remove this noise from current assets and current liabilities, because current assets and current liabilities, you can look up here, they take up a huge space. So that's total current assets. This is total current liabilities. They take up a huge portion of the balance sheet typically, not always, but typically, and it's just distorting the picture. It is, current assets typically would pay off the current liabilities. It's accounts receivable, accounts payable, some sort of cash on hands, some sort of accrued compensation, all kinds of stuff that is not really producing. Those are not tangible producing assets. So I want to remove my current liability from it because my current assets would typically cover the current liability. And you can verify that Microsoft has more current assets than it has current liabilities. So remove that. I also remove goodwill. I don't like goodwill. Being an accountant, I find it's kind of I don't know, a scheme, whatever you call it. Goodwill is not a productive asset in any way. It's just one company purchased another company. They identified every possible asset, including trademarks, patents, intangible assets, anything you can imaginable was measured. Everything else is called goodwill. It's kind of what we overpaid for the assets of this company. It's its good name, its supply chain network, its good standing relationship with its customers. Decades of relationships with I don't know suppliers and manufacturers. Whatever it is, you overpaid. This is it. You overpaid. You paid too much. This is not an asset. Get rid of it on a balance sheet. Well, the accounting standards don't agree with me. They want to keep it there. Let them be. I remove it. So my tangible assets are net of it. So here you go. I'm plugging that in. Wonderful. Current liabilities. I removed from total liabilities, right? So I'm coming up to net liability. And then from equity, I'm removing goodwill. As I said, I don't like goodwill. So net equity, net liabilities, and only tangible assets. This is the truer, in my view, way of assessing a company. And here's the debt to equity ratio. As you can see, it's been going down. It's under 1. Wonderful. Debt is becoming more expensive lately. We want less debt on the company balance sheet. Not necessarily, as in the case of Apple, they've been buying back their stock, so their equity could become negative. For all I know, eventually, Microsoft is also buying back their stock, and nevertheless, their debt to equity is decreasing. It's not becoming negative. So every company has its own story. This one happens to be quite positive. So great profit margins on the income statement, great balance sheet. Now take a look at the cash flow, because cash flow is ultimately king. I look at statement of operations, and what I want to see is that the operating cash flows, so here you go, 89 billion, operating cash flows are enough to pay for capital expenditures, because if the company is growing, the company needs to continue to reinvest in its assets, the company needs to continue buying back its competitors, and the company should generate enough cash to pay for their dividends. That's a given. Without reinvesting back into capital expenditures and acquiring the competition, they can probably not continue growing their earnings as much as they did. So those growth rates that we have seen, let's say in the income statement, you could see some income growth rates. Don't look at the minus 23 because this is not a full year, this is just 3 quarters. So it's really in the last year they've grown their income by 38 and 19% respectively. Earnings per share 40 and 20% respectively. So to continue growing income at those levels, you need to reinvest back. And if your operating income is not covering those expenditures and acquisitions of other companies, then you're probably not going to grow as much and eventually you're going to die. So what is left after all of these kind of commitments are made is what I call cash for financial management, and it's still plenty. It's not negative, so that's wonderful. They don't have to go into debt. They generate sufficient cash for their internal purposes. I also want to make sure that it's plenty to cover their dividends. The dividend is safe. So the free cash flow though is without the dividends, so that's another metric I look at. Look at their number of shares. Number of shares are visible on the income statement. If you go here, you could see the weighted average shares outstanding. I look at diluted, that's basically stock options are considered that they've paid to their senior executives, all kind of warrants, whatever they've given. So fully diluted, looking at it, Microsoft has clearly been decreasing their number of shares. That's wonderful. We as shareholders will get a bigger pie of that company. So we look. So I calculate that free cash flow per share as just a straight formula in Excel, and then I look at the stock price. And stock price, simple chart. Like there's nothing fancy about it. Just go here. I roughly look at the last 3 years. I sort of look at the date of the financial statement. So Microsoft year end is June. So you go to June. And you say, well, okay, roughly 29th of June, this has been something like $195, give or take, right? Plus minus a couple of bucks. I'm just looking for at it from the ballpark perspective. I don't want to be perfect. So 195 bucks in 2020, and so on and so on. Right now it's about 340 bucks. So how much are we paying? Not price per earnings, but what is the price per free cash flow, the way I have calculated it. It's a great company with great margins. It's a wonderful balance sheet. They're generating tons of cash, but are we paying for them too much or too little? Is this a bargain or is this a sell? No matter how wonderful the business is, if you overpay, your return is probably going to be lower. So based on my calculation, the price per free cash flow has been increasing, so it becomes a little more dangerous to buy Microsoft. I mean, 40s are too much. When we looked at Apple, it was 20 something. So Apple is way cheaper than Microsoft on this earnings ratio, free cash flow ratio. Now, it doesn't consider the growth rate, doesn't consider the stability of the company, does not consider competition of the company. There's a ton of factors to consider, but this is just a part of the fundamental analysis that you want to be doing. Now, looking at the very current 3 quarters, the price per free cash flow ratio is too high because this is 3 quarters. So if we need to increase that free cash flow to account for 1 more quarter that is coming. So there's going to be more free cash flow per share, and therefore the ratio of price divided by free cash flow will be lower a bit. I did my guesstimate and it's about 70. 70 is a lot. Not only it's a lot compared to say Apple or even ADP, it is also way higher than in the prior years. So Microsoft compared to itself. I do look at their dividends. Dividends are fantastic. They're increasing it by 10% a year. Heck, I didn't get 30% increase in my income that I get from a job or my business in the last 3 years. But if you invested in Microsoft, you got a 30% raise. Wonderful. Now, are we overpaying? I believe we are. The dividend is safe. I mean, if you want to hold it for long term, you're fine. But for now, I believe this is it. It's too expensive.